the sweet, intoxicating feeling of being right. The stock you own has been climbing for weeks, maybe months. Every news report confirms your genius. The company just announced record earnings. Analysts are upgrading their targets. Your friends are now asking you for tips, and you feel like a master of the universe. The urge to buy more, to mortgage the house and go all in, is almost overwhelming. This right here is the most dangerous moment in the entire life of a trend. It is the carefully constructed stage upon which the final act of a bull market is performed, and most people don't realize they are not in the audience. They are the unwitting actors. This process, where optimism is at its peak and the public is clamoring to buy, has a name. It is called distribution. It is not a sudden event. It is a slow, methodical, and deliberate campaign conducted by the market's largest and most informed participants. To understand it, we must first personify these forces. Richard Wyckoff imagined a single entity behind the major market movements, a composite of the most brilliant trading minds and the deepest pools of capital. He called this entity the Composite Man. This is not a conspiracy, it is a metaphor for institutional logic. The Composite Man, or large operators, behave like any smart business owner. When they want to buy a large quantity of a product, they do so quietly, at wholesale prices, without alerting the competition. This is called accumulation. Conversely, when they have a massive inventory of that product to sell, they cannot simply dump it on the market all at once. Doing so would crash the price, destroying their own profits. Instead, they must create a marketplace of eager buyers to whom they can sell their shares at retail prices, piece by piece, without causing alarm. The entire purpose of a distribution phase is to transfer ownership of shares from strong, informed hands, the composite man, to weak, emotional, and often uninformed hands, the general public. The fuel for this transfer is a powerful narrative. The story of the company has never been better. The future looks infinitely bright. The media becomes an echo chamber broadcasting this message of boundless prosperity. This is not necessarily a malicious plot. It's the natural outcome of a rising price. Good news attracts attention, and rising prices generate more good news. The large operators simply use this environment, this climate of peak optimism, as the cover for their operations. They are the wholesaler selling their inventory into the holiday shopping rush, knowing that demand is artificially high and emotionally driven. While the crowd is focused on the headlines, the composite man is focused on the order book. He sees the flood of buy orders from the public as an opportunity, the perfect liquidity to offload his large position without disrupting the price. He is feeding supply into a frenzy of demand. The law of supply and demand is the only law that matters. For a time, the public's enthusiastic buying can absorb the professional selling. But supply in this case is finite only in the sense that the composite man has a set amount to sell. The public's buying power, however, is not infinite. Eventually, the buyers become exhausted. They have put all their available capital to work. At this precise moment, the delicate balance tips. The massive hidden supply from the professionals finally overwhelms the waning demand from the public, and with no one left to buy, the price has only one path to follow: down. So how do we see this on a price chart without the benefit of knowing who is buying and who is selling? We must learn to read the footprints left in the sand. Imagine a strong, healthy uptrend. The price bars are long and green, moving upward with ease. The price is consistently making higher highs and higher lows. It feels effortless. Then the character of the trend changes. The upward progress stalls. The price stops making significant new highs and instead begins to move sideways, trapped between an invisible ceiling and a floor. This is called a trading range. It is the arena where the battle between professional supply and public demand takes place. Inside this trading range, pay close attention to the relationship between price movement and volume. You might see a day where the price tries to rally toward the top of the range. The enthusiasm is palpable. The volume for that day is huge, far greater than average. Yet at the end of the day, the price has barely moved up. It may have even closed back in the middle of its daily range. This is a critical clue. Wyckoff called this principle effort versus result. The massive volume is the effort. The lack of upward price movement is the result. Imagine pushing a car with all your might, but the car barely moves. It tells you something is blocking it. In the market, that something is a massive wall of hidden sell orders. The large operators are meeting the public's buying enthusiasm with an equal or greater amount of supply. This phenomenon is often called churning or absorption. The volume is churning, but the price is stuck, like wheels spinning in mud. The Composite Man is a master of psychology. He knows that to sell the last of his inventory, he needs to create one final, desperate wave of buying. He needs to convince the remaining skeptics that the trend is about to launch into a new, even more spectacular phase. This is often achieved through a maneuver known as an upthrust or a bull trap. Imagine that ceiling of the trading range we discussed. After several failed attempts to break it, the price suddenly surges through it with conviction. It looks like the breakout everyone has been waiting for. This move is often accompanied by a positive news catalyst, a surprisingly good earnings report, a new product announcement, or a government contract. This is the moment the breakout traders who were waiting on the sidelines jump in. This is the moment people who feel they are missing out finally capitulate and buy. This creates the final burst of demand the Composite Man needs. He sells aggressively into this manufactured excitement. And then something changes. The breakout fails to follow through. Instead of accelerating upwards, the price stalls and within a few price bars falls right back down into the old trading range. The door has been slammed shut on the buyers. Anyone who bought the breakout is now trapped in a losing position. This failed breakout, this upthrust, is one of the most powerful signs that a market top is in place. It is a definitive statement that the supply from large players is now in complete control and has overcome the last gasp of demand. Following the upthrust, the subsequent price action is telling. The rallies become feeble, failing to even reach the previous highs. The price starts to lean heavily on the floor of the trading range, testing it again and again. Each test weakens the support, like a battering ram against a castle door. The character has shifted from bullish to bearish. The path of least resistance is now to the downside. The public, who bought with such hope at the top, is now beginning to feel the cold grip of anxiety. Their dream of riches is turning into a nightmare of mounting losses. This brings us to a practical framework, an algorithm for identifying and acting upon a potential distribution top. It's not about prediction, it's about preparation and reaction. The first phase is identifying the setup. The context is everything. You are looking for a stock that has already had a very long, sustained uptrend. The longer and more mature the advance, the more likely it is to be nearing its conclusion. The public is euphoric and the news is universally positive. This is your background condition. Then you observe the price action transitioning from a clear uptrend into a sideways, choppy trading range. The ease of movement is gone. This range is the potential distribution zone. Within this range, you must be a detective looking for specific clues. Look for instances of effort versus result. High-volume rallies that make no price progress. This tells you that supply is present. The most crucial part of the setup is the appearance of an upthrust. A breakout above the trading range that quickly fails and returns to the range is a major red flag. This is the Composite Man's signature move. The second phase is the trigger for action. It is tempting to act on the first sign of trouble, but professionals wait for confirmation. An aggressive entry would be to initiate a short position, that is, to bet on the price going down, as the price falls back into the trading range after the upthrust. The failure of the breakout is your signal. A more conservative and often safer trigger is to wait for the support of the trading range to be broken. When the price decisively falls through that floor, especially on an increase in volume, it is a sign that the last line of defense for the buyers has collapsed. Wyckoff called this falling through the ice. There is nothing below to hold the price up. Another high probability entry point is what's called the last point of supply. After the price breaks below support, it will often have a small, weak rally back up to that broken support level. This is the market's last gasp. When this feeble rally stalls and turns back down, it is a very reliable signal that the downtrend is in control. The third and most critical phase is capital protection. Your stop loss is your insurance policy. It must be placed based on the market's structure, not on an arbitrary dollar amount you are willing to lose. If you enter by shorting the failed upthrust, your stop loss should be placed just above the high of that upthrust. If the price goes back up and exceeds that high, your thesis is wrong, and you must exit the trade immediately and dispassionately. The market has proven your analysis incorrect. If you enter after the price breaks below the support of the trading range, your stop loss can be placed just above that broken support level, which should now act as resistance, or above a recent minor high within the range. The purpose of the stop loss is not just to limit financial loss, but to protect your mental capital. It admits you were wrong and allows you to move on to the next opportunity with a clear mind. A professional trader accepts small losses as a business expense. An amateur lets a small loss turn into a catastrophic financial event due to hope. To truly internalize these concepts, the serious man must return to the source. The foundation of modern technical analysis is contained within Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds. This is the original, timeless wisdom presented in the Annotated edition by Max Davidson. The annotations provide necessary context and clarity for the modern environment, ensuring the original principles of trading as a serious business, risk management, and judging the market by its own action are preserved. The link to this book is in the description below. Now, we must consider the variations, because the market is not a perfect machine. It is a dynamic environment and patterns can morph. What if what you've identified as a distribution range turns out to be something else? The primary alternative is a pattern called reaccumulation. This is also a sideways trading range, but it occurs in the middle of an uptrend, not at the end. It is a pause, a period of consolidation before the next major leg up. The Composite Man is not selling here. He is adding to his position or simply waiting for the market to digest its recent gains. How can one tell the difference between a sinister distribution and a benign reaccumulation? The answer, again, lies in the volume and the character of the price action within the range. In a reaccumulation range, you will typically see volume diminish on the pullbacks. When the price dips toward the floor of the range, the selling volume dries up. This is a sign of no supply. It tells you that there are no large sellers interested in pushing the price lower. The pullbacks are shallow and quiet. Conversely, the moves to the upside within the range tend to occur on expanding volume, showing the enthusiasm of buyers. In distribution, the signature is often the opposite. The rallies toward the ceiling happen on huge churning volume that accomplishes little, while the drops toward the floor of the range often occur with an expansion of volume, showing that sellers are becoming more aggressive on the declines. The overall feel of a reaccumulation range is buoyant and resilient, while the feel of a distribution range is heavy and labored. Distinguishing between these two is one of the most vital skills in reading the market. A mistake here means you are either selling just before the next major advance or buying just before a significant decline. Another scenario to consider is what happens if your timing is slightly off. You identify an upthrust, you enter a short position, and you place your stop loss. But instead of falling, the price simply goes sideways and then makes another attempt at a new high, stopping you out for a small loss. This is part of the game. The market does not always move in a straight line. Sometimes a distribution range can have multiple upthrusts, each one designed to shake out early short sellers and trap a new group of buyers. The professional does not see this as a failure. They see it as new information. The fact that the second breakout also failed to hold reinforces the original thesis that supply is dominant. They will simply wait for a new, confirmed trigger to re-enter the trade, perhaps at a better price, with their risk still clearly defined. Patience and adaptability are paramount. The market does not care about your initial opinion. It only rewards your ability to align yourself with its true intentions, which it reveals through price and volume. In conclusion, the market top is a process, not a single event. It is a period of transition where the ownership of an asset is carefully passed from informed professionals to the hopeful public. This transfer is cloaked in the most positive news and driven by the most powerful human emotions: greed and the fear of missing out. The professional understands this. They ignore the news and study the tape. They watch for the telltale signs: the slowing of the trend, the churning volume, the failed breakouts, and the change in character from effortless ascent to labored struggle. They do not try to pick the exact top, an exercise in ego. Instead, they wait for the market to show its hand, for the evidence of distribution to become undeniable. They wait for the ice to crack. This approach requires a profound psychological shift. It demands that you stand apart from the crowd, to be skeptical when others are euphoric, and to be patient when others are frantically chasing the last tick of a move. It requires you to trust the story told by price and volume more than the story told by the headlines. By understanding the mechanics of distribution, you are no longer a victim of the market's grand dramas. You become an informed observer, capable of recognizing the end of one chapter and preparing for the beginning of the next. The market is constantly communicating. The skill is in learning to listen to its true voice. If you want to understand more of this language, stay with us.